My name is Gary. I will be with you for the next 2 hours to present to you some guidelines in regards to technical analysis. It's one of our first time we are conducting a webinar with so many market participants. So we hope that you will not face any issues, technical issues, bugs, or anything of that sort. Look, we have a team of people around me at the moment who can help you if you are facing any problem, but you have to let me know through the chat. They will be able to interact with you if there's any problem. So let me first go back to the presentation page. Before we start, let me just introduce myself to you a bit. My name is Gary. I come from France. I have been trading the last 8 years now. Here, my role at Professional Traders Club is to look after the training department. I have actually built and conducted a course around the thematic of futures and of Forex. So I have been spending 5 years, my first 5 years of my trading life experience into futures industry, and in the last 3 years I have been slowly adding the Forex leg to my set of knowledge, which now I'm going to explain to you. So we're going to be spending a little bit of time talking about technical analysis as a subject around the Forex currency. I mean, around the Forex underlyings. So if it is not a product that you're looking to trade, it is not a problem. It's not an issue at all. The technical analysis thematic is agnostic of any asset classes. So you will be able to understand through this workshop loads of, I would say, different ways that I conduct my trades and learning how I read the price action. But before I start, I want to introduce myself to you, and I'll explain to you exactly why we're going to spend time on technical analysis today. I started my trading experience at Millennium Partners in Paris in 2010, right in the middle of the house market crisis. I spent about 1.5 years with my first company, after which I decided to come to Dubai to carry on my trading experience on my own. I opened a trading company here. I traded for myself for about 2 years with my own assets. I chose to move on to a company which would have major substantial assets. And I went to Riyadh in Saudi Arabia, where I was given the chance to handle the capital markets department. So during this time, the capital markets department were looking for a variety of investments to be conducted, from real estate investment trusts to Forex to the futures arena, and obviously they had also their portfolio of stocks in Saudi. So after this experience, which has lasted about 1.5 years, I came back to Dubai, and for personal reasons, as I'm married, my wife here, and I gave most of my time now to my trading here in Dubai, and at the same time to Professional Traders Group as a trainer. So to give you an understanding of what we are going to do today, the technical analysis course is not on its own able to help you find all the solutions to your trading problems. Let me explain. You need to figure out, by looking at the past historical data on your chart, let's say, for example, you're trading on Forex, you need to look for a good time to enter and at a good price. So technical analysis is a domain where people will be able to find when to enter in the market and where to enter in the market. That is the purpose of technicals. But the thing is, you don't get to know in which direction the market goes. A lot of people get this part wrong. They think going through technical analysis will help them to sort out the major problem that they have, which is every time I'm trying to do something based on a signal, I buy, and it happens to me the market goes down. Or vice versa, they would be selling and the market would go up. And it's almost as if the market would know exactly what they were meant to do. They knew they knew where most likely you would be putting your trade to buy or to sell based on all those indicators of yours that you would have around you. And because of that, unfortunately, people would start feeling like technical analysis is somehow not working for them, or that the strategy they have built with technical analysis tools are not performing enough, so that they will have to scrap it and turn it into something else. So they would keep on changing strategies on and on until eventually they would get tired of doing that and they would give up trading. So technical analysis will help you, but it will not solve all your problems. And you have many, many different problems. The first one is you need to know in which direction the price goes. And that, for sure, technical analysis will not help you for that. You need to look at the big picture of the market, understanding which direction the market goes through fundamental analysis, through macroeconomics, understanding the waves of the big players in the market, through news statements, leader speech, going through something we call market sentiment, understanding at any point of time how many buyers or sellers are entering in the market, to know which one is actually acting stronger on the other. These things are micro analytics up to macro analysis for you to at least feel in which direction the wind goes. Unfortunately, we won't have time to cover this area today. So understand very well that whatever I'm going to show you, there's a lot of things that are missing in there that you cannot solve the problem of what kind of trade is more likely to fit my style, or how do I manage to get in the right direction. Now, technical analysis happens to solve another a big problem, which is the timing and the price, the time and space in which you need to operate. So in other words, you want to find a good price to act in the market, and you want to find the right time to enter the market. This is why we use those tools, and those tools are very, very, very important. You have many, many technical indicators in the market that are available for free. You have many technical tools that you need to plot manually on the chart, like support and resistance, supply and demand zones, linear regression channels, trend lines, and so and so. Fan lines, there are many, the pitchfork, all of which you need to find your space and use the tool that makes you feel comfortable. But you cannot use your own, it's not possible. Now, there's another side of the market story that you can't find neither with fundamental analysis or with technical analysis, and that is behavioral analysis. In other words, you need to understand who's in there and who's acting in the market at any point of time. You need to understand which market participant is most likely to operate in the market right now, at the time when you want to enter it. To answer this question, you need to understand the price action of the market, and to do that, then you have to be able to read price action with techniques that I call behavioral analysis. In behavioral analysis, you will know who's entering and why they are doing what they are doing, why they are entering now the market. If you can combine fundamental analysis, technical analysis, and behavioral analysis, you have everything you need in order to have your green light the one that you need to move in the right direction. So for today and for those 2 hours, unfortunately, we will only operate on the subject of technical analysis, which you will see is a vast subject, and everyone has its own opinion about it. I do have my own way of using those tools, which you won't find anywhere in books. And I think there's many interpretations of what a trend is or what a range is that there are people out there trying to trade the market. So I would like to first, before we move into more technical analysis, at least I need to give you an understanding of some behavioral analysis. When you start looking at the price, let me just show you. Okay.
Oh, sir? Are you?
Yes, I'm trying to find up. Okay, sorry guys, I've just been informed that for most of you who have not, mute your mics, you need to actually turn off your mic, please. Or if you have a mic that you can deactivate by just removing it from your main PC station, please remove it because it creates interference on the line, and somehow other people on the line might not be able to hear what I have to say. So as of now, I don't need to hear you. I won't be able to hear you anyway because it would create too much problem with one line. So you can actually interact with me on the chat line. Where is it? Here we go. So I can have access to the chat line. I have teams of people with me right now who can access the chat line. If you have some questions, don't worry. But please, I need you to deactivate your mics. Thank you. So I would like to. Okay, good. So sorry, I need 1 second. Can you please come? I need to be able to switch from OneNote to the presentation. Okay. Earlier I couldn't do it. So actually,
just
no, but it was not like this earlier.
So if you're on the presentation.
Okay. See, it's not working like that.
Like.
Sorry guys, just give me a second.
Just exit. So you can stop the share.
Mm-hmm.
Open up after that.
I can't have access to the button.
Do you want the constant?
Yes, I want to have it, like I used to have it. Okay, good.
Okay.
All right. All right.
Do you want to continue sharing?
Yeah, I'm back. Okay, good. So we're back in. Let me explain to you first how the market participants work. We have actually 3 sorts of market participants in the market that are important for you to understand before I introduce you to what is a trend, what is a range. At least you need to know how to lecture a trend right. So there are actually 3 categories of market participants. All right. The number 1 so we have the leaders. We call those leaders the whales in the market. Imagine watching the sea full of fish, and the biggest one of them will obviously be the one who will give the tone to the waves in the sea. So the whales are what we call in the industry the RM. The RM are actually real money players. So these type of people are basically big enough because they operate with more than $30 billion of asset under management. To give you an idea of some of them, you will find big banks. You will find investment companies like Berkshire Hathaway, Soros Management Fund. You'll find pension funds or insurance funds or mutual funds, all of which will operate on the basis of the money they have. They don't need to borrow much money from banks, from financial institutions, because they are too big and they don't know what to do with their money already. So they have difficulty to put that money in the market without affecting the price movements, which obviously will be a problem for them because they will never be able to buy at the best price or sell at the best price. The number two people are what I consider as the sharks. And the sharks will be the LM, also called leveraged money. Okay. Now, leveraged money players will be hedge funds, also fund of funds, real estate, investment, trust scheme, etc., etc. Anyone who is operating at this level will actually work with more than $200 million. Obviously lesser than $30 billion that I mentioned here. And the last one will be what I consider the small fish, and they will be what we call the FM, the fast money players. And the fast money players will be speculators, proprietary traders, also trading arcades, like we are here. As you may know already, at the Professional Traders Club, we offer rental desks for traders who come in and want to trade with a physical access to the building by using Bloomberg, Reuters, being able to be in a community of traders here, interacting with other traders, being able to use the Squawk Box, which is the radio where information is delivered, all of which is possible in the trading arcade. You will find also trading companies. Could be physical trading companies, could be trading financial markets. Anyway, as long as you operate with less than 200 million, you're called a small fish player. All right. So having said that, what we need to understand is, I believe most of you, when you start trading, you will be entering this category. All right? And as such, you will have to be careful at what the sharks are doing and what the whales are doing. You cannot operate in the market by being blind of what both those parties, market participants, are doing. Otherwise, you can end up just like you can end up like a victim of those market participants. A shark is a shark because he is taking the risk. He is absorbing the risk on behalf of the big market players. To explain that to you once with some example. Let's consider a big player to be Airbus or Boeing. And you can imagine those big players needing to access the market because they want to hedge their risk. They want to be able to put in some money into the market, or to be able to protect themselves against the risk of holding a physical asset by trying to place an order in the market which does the opposite of what they have. If they have bought that physical asset, they will try to operate in the market to sell on another market that is correlated to the physical market that they hold. So in other words, if they have physical gold, they will be looking at selling on a derivative market of the gold market as a sell. Why? So that no matter in which direction the price goes, they will be having a coverage of their currency fluctuation risk. They don't want any of that risk to impact them, because their business is not made on the hypothesis that a market price will go up or down. They are just choosing the market as an arena where they will find a seller to their product. And if they have manufactured that product at a certain cost, like Boeing would manufacture wings in India, will ship those wings to after getting the raw material from China, shipping those raw material to India, manufacturing those wings, transferring those wings from India, for example, to Mexico. All of these things need to use some amount of currency in different currencies. And during this time where they are building an aircraft, it takes probably about half a year, if not a year. And when they are delivering that aircraft on the D-Day, obviously the person who is their client will be putting the money on the table, which has been previously negotiated something like a year back. And that money doesn't have the same value today that it had a year ago. So they need to be careful when they receive that money in 1 year, that the value of that money is not depreciating over time. And the inflation is hedged, and the risk of market price risk is hedged, and the risk of currency fluctuation risk is hedged. So all this is why the market exists. It exists only for the big players to be able to hedge their risk. And who is going to be the counterpart of the risk? Who's going to be the risk taker of the big player? It will be the medium players, who are the sharks. Their role is to be on the other side of the position of the big player. Let's say, for example, a big player needs to sell on the derivative market. Well, he needs to find someone who wants to buy to him. Having that someone who is putting himself against them as a seller, that someone needs to buy with the same amount of quantity. But nobody is as big as a big player, right? So this medium fish needs to leverage his size. That's why we call them leveraged money players. They need to borrow money in order to look bigger on the market than they actually have. And when they do that, well, at some point they can operate on the same level at the same time as a big fish player, trying to enter the market cheap at the time when there's a big market trying to exit the market, for example. So if they try to enter when it's cheap, they need volume against them. That's why the big sharks are the risk taker of this big fish. They will put their buying volume on a lot of selling volume. Now, understand, when the sharks do that, they don't do this for free. They don't try to give money to big fish. No. They are trying to get into the market at the cheapest price possible, so that they will also try to take advantage of someone. Now, that someone who is going to be a risk taker for the medium fish will be nothing else than the small fish, because there's nobody else left. And the small fish is us. Now, the problem they have to find small fishes is not as they don't trade as easily as the big fish would trade when trying to find a medium fish. Why? Because medium fish, there are not so many of them, and they are pretty much big enough to all come at one point of price, one point of at the time, at one particular price, to give their money to a big fish. The problem comes when a medium fish is trying to hedge its risk. Suppose, like our example, our previous example, the shark is buying, and he needs to hedge its risk by selling on another market, which is supposed to be correlated. He needs to sell to someone, and that someone is us. The problem is we are not located at one spot, at one place. We are disseminated everywhere in the market. We are so small that it takes a lot of effort for a medium fish to hit us all. And it takes a lot of energy for him to do that. So that's why most of the time they are not hedged. They are what we call in an outright position. They are not, they are in a directional momentum. They are not properly secured. They need to identify where most likely we stand at, the small fish, where we are mostly located at, because it will take less effort and less time consumption, it will be less time consuming to come at one spot of the market price to hit us all. And by doing this, they will preserve the energy, they will preserve the risk of being in a directional leg, because they will be able to take food from us, and a lot of food, all at once. Now, to do that, they need to know where the small fish operate. They need to be able to find where the small fish will be the most comfortable to enter the price. And this, obviously, it is not science fiction. It takes them simply to try to understand how they think. Most amateurs, this is what the denomination of a small fish is. Most amateurs, they will do the things in the market that make them feel comfortable. So if I tell you the market is low, it's a good time to buy. And if the market is high, it's a good time to sell. This obviously is one of the most predominant views in the market, which obviously is contradicting with what we should be doing, as this is too obvious. And the obvious is not rewarding at all. Now, another thing that is obvious is, so one confusion is to consider that low is cheap and high is expensive, which is a nonsense. So I would like to start with this. In the market, low is the absolute, has nothing to do with the fact that the price is cheap. And being in a high momentum of the market doesn't mean at all that the price is expensive. Most amateurs have the view that they should be thinking low and high in order to operate the price as buy and sell. What we need to do as a professional is to look at the market from this point of view. Yes, the market at some point is cheap, and yes, at some point the market is expensive. But that doesn't mean that it is low for it to be cheap. I will show you examples where the market is high and it's cheap for a buy, and the market is low and it's cheap for a sell. So that's the first thing. Now, another point I would like to say, well, in regards to those amateurs, is that they think the market based on something that is some tools that are already existing somewhere out in the market. You know, those tools that you have on your platforms to trade with, they can be easily plotted. I'm talking about the technical indicators here. You can find them either displayed on the chart, or you can find them underneath the chart in the form of an oscillator. Both of them, you don't have to do anything to move them towards the present situation, because they are actually automatic indicators. Automated indicators, they will facilitate. Oh, sorry. I'm having someone. Okay, did the video disconnect? Shezad Asgar is asking, did the video disconnect? I don't think so, Shezad.
It's a problem.
Wait, just let. Yeah, it's fine now. No problem. Good. I'm happy to see we're back in order. So just to understand, amateurs will use what is out there available. So they will go on YouTube to find reasons to build a strategy, to listen to somebody else saying, for which they have no idea whether it is reliable or not. They will be looking at any books that says on it bestseller from an ex-Goldman trader, ex-Goldman Sachs, or ex-Lehman Brothers, and all of which are fundamentally wrong. Because think about it 1 second. If these guys were good and they were making money, would there be having that much time to write a book? I will be honest with you. This is because they have ego. They are arrogant, and they don't want to. Let this great momentum they used to have go. They happen to have made probably a lot of money somehow at some point during their life, and maybe they are living on a different lifestyle today, and they want to stay in or feel like they are in. So this is totally wrong to rely on those kind of people. What I'm saying is, you would do a much better job at finding what to do and to do best in the market yourself, rather than looking back at someone that you're trying to rely on, that you have no idea who he's coming from and what he has done in his life. And this is also my view when it comes to YouTube video channels and podcasts and things like that. Or even worse, you will find on many, many different websites so-called technical analysts who are giving you for free suggestions whether it's good to buy or sell. Now, because I'm telling you, those guys, one thing about them is that they are not on the buy side activity, they are on the sell side. They are giving you a service, and they are trying to bring you to their webpage because maybe they want to sell you something else. They don't give you this information for free unless it's again another. It's just to show themselves and to make a name out of themselves. The second, these people, they will give you an information. When you look at the way they are ranking themselves on their websites, it's generally about. It's never about when they go wrong, when they didn't find out what to do. By the way, there's never a stop loss or target profit when comes those signals. They generally tell you to buy or to sell. They will tell you when to buy, but they will not put stop losses or take profit on it. So if you look at how many times they were right in the direction where the market goes, it will probably be a game of 50-50. And having said that, I'm not trying to say they're not good at analyzing the market. No, I'm just saying they are lacking of some information in order to have the full picture. And when they give you this buy or sell signal, they will basically show you only the good times when they were right. This is how they rank themselves. They only classify themselves as how many times I was right. And you will find out there the top 3 where the people were the most right. The thing is, they've tested if they've done a lot of analysis, and they were a lot right and a lot wrong. Well, even though they were 50 times right, with 50 or 60 times wrong, you will never see that space, how many times they were wrong. And obviously, this saying that if they were good at what they do as technical analysis, they would be in the market, and they would not have time to spend in giving you those tips for free. So, giving you something which has an adding value is not available out there in the market for free. That's what I want to tell you. Now, coming back to what we are going to do today. And please, again, I'm not trying to discourage you from looking around and understand the market by yourself from books. No, I'm just telling you there will be times when things that you will read out there are of no use. And I will give you, if you want, before the end of this session, some books to read, which are mostly related to psychology in trading rather than in technicality in trading. So to give you an idea about technical indicators. We were saying that technical indicators were available for free on any platform. Well, no, you will notice something about them is every time you find yourself in a situation where suppose you use 2 or 3 of them at the same time, moving average, MACD, RSI, for those of you who know what I'm talking about. And suppose you would find a good signal to buy, not only on 1, not only on 2, but on the 3 of them at the same time. What do you think will happen? You know, there will be George somewhere in Johannesburg. There will be Vikas somewhere in India. There will be Gary somewhere in Great Britain. And all of which, these guys will see at the same time the same signal with different instruments. What's going to happen is that at the same time, they will operate a buy or a sell. What does it mean? If there's an excessive volume coming from small fish, doing the same thing at the same time, because of those technical indicators telling them to do so, as stupid as there's a buy signal, they buy it. There's a sell signal, they sell. What do you think will happen? The market will actually start moving completely the other way down. As what has been the most obvious way of entering the price turns out to become the weakest way of making money, as it's the most obvious. And the more something is obvious, the more chance you will find out there sharks and whales using instruments like algorithms, artificial intelligence, in order to build a sequence of trade in order to play against your trades. And to play against your trade is not that difficult. If you are buying all at the same time, but there's a seller in front of you who is bigger than you in volume, he will start pushing the market against you. And you will do this until you guys reach your stop loss, which is a level in the market that you plot in order to not lose more, basically to get you out of the market with maximum loss. If that was to happen, eventually you will end up crying or moaning that something went wrong about your strategy. You know. And you know, most likely you would see the second negative effect of it. The market starts going in the direction just after you touch your stop loss. That's horrible, because you feel like somebody is watching what you do. And sometimes you will look at yourself saying, damn it, I know something is happening out there. For people to see what I'm doing, they can find my stop loss, they can see where my stop loss are. It's true, but it's not only that. You can even not put your stop loss and decide to get out at this particular level. The problem is that everyone out there would have a certain resilience for losses. And those artificial intelligence machines, they know where to find the moment where you guys are going to break. You won't be able to stand any longer in the market. And they will test you all the time on those easy levels, the obvious levels. So another thing I would like you to learn from this explanation is that technical indicators cannot be used the way you read them you read about them in books. With the parameters, the settings that are available out there on the internet. It doesn't matter what you hear, you read out there. Oh, this guy is making money with this technical indicator. This guy is knows how to use the technical indicator with an edge. They know something that you don't know, or they use it in a different way that you use it. At least they will have developed a system behind that technical indicator that will be an edge. They will be thinking outside the box, which means that they will not operate a buy on the signal of a buy. They will wait. They will delay the entry. They will go against what that buy signal means. Or maybe they will use the buy signal just for the sake of knowing that now they have to enter, like I told you earlier. As a technical analysis tool, they will have a momentum to enter. But buy signal doesn't mean buy. Maybe it means it's a good time to sell. So you would have to be careful when choosing the technical indicator that you want for your trading. Me personally, I'm choosing not to use any of them. So today is not about showing you how to trade with technical indicators. The reason why I don't want and I don't like technical indicators is because they give you an information for the present time based on past historical data. which means that they are late by giving you an assumption of what is the energy of the market right now. They give you a center of gravity of an acceleration for some of them. They will give you a center of gravity of an appreciation where the price stands from a high-low perspective in the last 20 periods, whatever that time frame is. Let's say you are trading on 1 hour, so in the last 20 hours, they will be telling you, I'm standing high in the last 20 hours momentum, or I'm standing low in the last 20 hours momentum. This is another indicator. But truly, you are still looking at the past. And I'm sorry to tell you today, maybe it's going to shock a lot of you, but the market is all about the present. And whatever you have read about the past belongs to the past. And the most recent past may have some kind of influence to the decision-making process for you to enter the trade right now. But the past picture that you see from the first half of your chart has absolutely no repercussion, no impact on what you're about to see or whatever you're about to face as a price action now. So having said that, most technical analytic indicators operating from a past point of view are of no use. The second reason that I would like to highlight is that when you analyze an average of a past price action to indicate to you where you are staying now from an average point of view, where are you from the mean of the market? The problem is you are looking at an information that is lagging. Lagging, I mean that the information doesn't give you the current market effect. It is giving you an average of something that has been happening in the last 80, 200, maybe more periods in the same time frame. And by the time you find an opportunity to buy, the reality is, if you are not operating with those indicators, you may be able to find a buy much earlier. And by the time you see that signal for you to enter on with the technical indicator, it is time for you to exit that buy rather than entering it. So most of the time, when you operate on the basis of the technical indicators, you're operating way too late in the market story. And this obviously has repercussions in your trading because you're simply an amateur entering during an amateur time, which is obviously the worst. All right, so I'm hoping that this little introduction has helped you understanding the different, oh wait, I have SS, who's it? Telling me no audio. Your video keeps getting interrupted by Shezad Asgar trying to start a video. Okay, sorry guys, just give me a second.
No, he's not sharing.
Sorry?
He's not sharing anything right now.
No, there's nobody interrupting the line. It looks no one there to assist. No. We have a full team of technical analysts here, of analysts, sorry, not technical analysts, who are helping me. But you are a lot actually as you are a lot of participants today on this webinar. So I obviously can't speak and at the same time intervene from a technical point of view. So don't worry, just let these guys sort the problems out. If there's any interruption in the line, if you have missed something, don't worry, I can repeat it. Don't worry. Just give us 2 minutes. At the moment, is there any question? Something you would like to say, something you would like to ask? I know it's always easier when you are in the class with me, but I have some time if you want, like for the next 5 minutes. So you can write your questions on the chat, guys. I don't know why, but SS seems to have some audio issues. Okay, let me know, guys, if you have some issues of any kind. If you don't understand something, this is more something I can help you on. Okay. I can see some exclamation points next to. Oh, okay. Yeah, I'm looking at it. How do we, as lay people, judge the market if we assume that all accessible technical indicators have an ulterior motive? So I didn't get one word from you. Is this one? Mm. Okay. Okay. I'm sorry, I'm still not getting the question. That first question. Sorry, just 1 second, guys. Husna, sorry, can you just rephrase your question? I'm not getting it. I almost can understand most of what you've written, but now people don't see me. It's getting better and better. Okay, wait. I'll answer most of your questions. Yes, I will be talking about Fibonacci in the second part of my presentation, just to give you an idea of which type of tools I'm using in my trading. You will see it's one of my favorite tools as well. It gives me a lot of understanding of what's happening right now in the market, and it reveals where the center of gravity of the stop loss of amateurs. So I need that tool a lot. Oh yeah, wait, I got it almost. How do we understand the market if the technical indicators available online have some reason to influence us, amateurs? That's a big question, Husna. Okay, we need to operate the market from the point of view of technical tools and not with technical indicators. So I'm going to use support and resistance, supply and demand zones. I'm actually plotting my technical tools myself manually. Every technical tool that is given to you, not only for free, but is easily plottable on the chart and can give you an information without much effort coming from you, has no value, has no meaning, because everybody can use them. And think about it this way. If everybody can have access to that same indicator as yours, will find the same signal as you, then you don't have an edge, right? So if I could just go back to your question, make sure that I got that point right. Please, guys, give me the control of the mouse.
Can you close the chart?
No, I need the chart. How can I see? So how do you understand the market if the technical indicators available online have some reason to influence us? They have reasons to influence our decision in a way that we need to stand up from the amateurs, meaning we need to understand how amateurs operate. By using those indicators, we can eventually have an understanding where they enter without looking at those indicators, but using other methods where we can find where most amateurs enter. Those indicators will be one of them. And we will look at identifying where the stop loss of those amateurs are. Having said that, if we can put an entry level for us on the stop loss of those amateurs, we have an edge. We can enter at a better price than what that previous price was, for the same direction where the market was supposed to go to. But us being entering afterwards, after the amateurs get in, we will be able to get in at a better price, not being stopped out the market, while these guys will be obviously kicked out of the market, giving us the food. So we need to think like a shark. And this involves the use of multiple time frame analysis. When we trade a certain time frame, we are trading with among a certain amount of market participants, at a certain category of market participants. Let me explain to you. When you are trading on a time frame like H1, now I'm going to show you what it is. Okay, let me just close this. I will explain to you. Okay, let me show you something, guys. This is a platform that I use with everyone that I'm training Forex to. It is called FXCM. You can easily have access to it. I'm not trying to promote any platform, but it is true that FXCM is one of the most user-friendly ones that I have had the chance to trade on. Okay. Now, you will be asking me some questions as why am I using black candles and not red and green candles? I'm going to answer to those questions after. It's part of my presentation today. So here we are standing on a chart which is operating on this time frame, meaning that every market story that we can see here, which is displayed as in the form of a small candle, we call these candlesticks, will display 1 hour of market story. So 1 hour after each other, you will have a new candle forming. So to give you an idea, right now it's almost 4 p.m. in Dubai. You will be seeing a new candle at the end of, let me just change the time, sorry guys. So I'm going to set up the local timer. We are in Dubai time now. So it's 3 p.m. This candle is open at 3 p.m. It will close at 3:59 minutes, 59 seconds to open a new candle at 4 p.m. 00. So having explained to you this time frame, now I just understand one thing. When you are on H1 time frame, you operate with the amateurs. You operate with the small fish. Anything that you will find as a trader trading on a time frame lesser than an H1 time frame, H1 time frame will be small fish. So an M15 player, an M5 player, an M1 player is a small fish. If you want to understand where sharks operate, you need to be on H4 time frame. This is where the hedge funds analyze their trades and find ways to kill you guys that are trading on H1 time frame. H1 may sound like very, very reliable as a time frame for a lot of small fishes out there. But the truth is, it's where all the small fish converge to find the most reliable time frame. The reason is, on H4, those small fish will not have the amount of capital in their account to survive the game that is played on H4, meaning they wouldn't be able to enter on H4 with a stop loss based on the H4 market story. This will obviously affect them too much. So they try to enter in a time frame that is not too low, but as high as possible in the most reliable time frames for them to not be visible or not to be killed. Unfortunately, they are trapped because this is exactly how everyone thinks. So H1 will be where the market makers, the sharks, will operate to kill the small fish. H4 will be where the sharks enter and exit. And D1 is the time frame that is preferably used by the big players, the big banks. And you can operate as a big bank for duration times on D1 that can range between 2 months up to 2 years. Generally, we will operate on D1 for a time frame much lesser than that. We will generally enter the trades on D1 as a D1 player between 2 weeks to 2 months. Between generally 2 weeks to 1 month. So D1 players will be the big fish, and the week 1 players. Well, I'm giving you a 1 minute, half a minute to think about it. If the big players are operating on D1, who might be the week 1 players? You can answer on the chat, actually, guys. The Fed, nice. The central bank, very good. The central banks will be week 1 players. And if you think about how the market works, now we need to understand a little bit which time frame is healthy for you to trade. You need to understand that the dynamic of the market happening on H1 has nothing to do with the dynamic of the market happening on D1. Why? Because as I explained to you earlier, the big fish kill the medium fish kill the small fish, we kill nobody, so an H1 player will not kill an M15 player, or an H1 player will not kill an M5 player. So that means that when we think these time frames, we cannot expect to play a game on H1 time frame on the stop loss of the H1 players, because we think like a shark, like an H4 player. We cannot trade that dynamic that we do on H1 on D1. Why? Because there's no such thing as a week 1 player, a central bank, who is killing a big bank. It is not their purpose. They are not in the market for that. So that's why you will find what you see in books, what you read in books about the technicality of support, resistance, trend lines, chart patterns. You might think that they work clean on week 1 or on D1, and you want to stay on those time frames for the reliability of using those concepts from the books. Why? Because you know nobody will be on those time frames try to impact negatively on your trades. But eventually, you think like that, you don't want the risk, you won't get much reward. Because in trading, risk equal opportunity. So think that the low time frames will give you, if you think outside the box, if you want to put yourself on the stop loss of most amateurs, you will get much bigger rewards for the risk that you are taking on those time frames like H1, like H4, than you could get from time frames like D1 or week 1. That's obvious. So it means we need to avoid H1 for beginning and use H4 on small lots. Well, if I was to give you an advice, I would say analyze the market always from the highest time frame to the lowest time frame first. You need to watch what's happening on week 1, understanding if there's any dynamic happening on week 1 before you could switch yourself to a D1 time frame. If nobody is acting on week 1, and you were to find out that some people are pushing the market based on D1, then you know where the big players are sitting, what they are doing, and if they are acting now. Suppose that on D1 nothing is happening, you're in the middle of nowhere, it's a range, there's no such thing as an acceleration, nothing's happening. That means that the people who are maybe transacting among each other are not on that time frame and maybe on the lower time frame. It's imagine yourself, if I throw a big pie of anything you want, big pizza, huge pizza in the swimming pool, in the sea, sorry, and you imagine big fish, whales catching big portions of that pizza. Obviously, they will be eating very quickly, and they will be leaving the sea with medium bits, medium portions. And once the danger is away, sharks will be coming in to try to take advantage of the medium pieces left out there, and they won't give much time for small fish to operate when they operate. They will try to hit them. And that's what they do. And then when they are done eating most of the food, they will leave everywhere small bits that are not interesting for a shark to eat, because it's not enough reward, and they will not try to do things clean anyway. They are sharks. They will leave the sea, and if there is nobody out there, no whales, no sharks, think about it, and you are the small fish, you can even operate on H1, knowing that there's no big player out there trying to kill you. And you will come in and take your small bits for yourself. So I'm not trying to tell you the story is always happening on D1 and week 1 for you to trade. You will find episodes of times you will find nothing to do on D1 and week 1 because the game is now played on H4 and H1. And during those times, maybe you'll just wait, but you won't get killed. If you were to do the opposite, which is trading H1 or H4 episodes of times, you will have to be careful, because when the game is played on the high time frames, you will need to be careful of what is happening out there for you to trade the lower time frames right. Other than this, you will be able to wait for the high time frame players to sleep, to step out of the market, for you to get in and not finding any danger for you to operate as an H1 or as an H4 player. I'm sorry I can't be more specific on the matter, because it takes me, when I give the course about these things, it takes about almost 3 weeks for me to explain these things in details. But just to give you an idea, this is what I would pay attention to when I start analyzing the market. First, the high time frames down to the lower time frames, and I will stop on the time frame where I see there's price action. Otherwise, there's no point for me going on H1 if I know that the game now that is played is on D1. You're welcome. Will this webinar be available in video format? Is it being recorded? Yes, it is being recorded, and we will make sure to make it available in video format, probably available on our website. I believe ROE, who is responsible of the business development here, will come to you guys with those answers. So you can always email her, but I will make sure that you get a link towards that page by the end of this webinar. No worries, guys. I would like to give you a 5-minute short break, so just for you to get some refreshments, eat something. I'll come back in 5 minutes time. So stay tuned. Thank you very much. All right, guys. I'm back. So sorry for the 5 minutes cut. I hope you have no connectivity issue at the moment. You should be back with me. If there's anyone having any lag, any problem, please interact with me on the chat. As I'm saying, we will be able to. Are you open today for visits? Yes, it depends at what time. If you are coming to visit me at 1 a.m., I'm not sure my wife will be happy. But if you are planning on coming somewhere around 5 p.m., I will be around the office. From between 5 to 5:30 p.m. today. Otherwise on Monday morning from 9 a.m. And we operate here from in the office from Monday morning 9 a.m. till Friday evening, and generally until 6 p.m. on Friday. All right. So let me now that you have understood the context, let me introduce you to some technical analysis notions. Just to give you an understanding, we have 3 different ways of interpreting the price. You can see the price from the line chart. The line chart is just a line connecting the close price at the end of every time frame period. Let's say we are talking on 1 hour time frame. You're trading on 1 hour time frame. At the end of each hour, you will find a close price, and finding one close price after the other. You just need to connect them one another, and it gives you that line chart that you see here. Today, there are a lot of traders who are trading on the basis of a line chart, myself included. Not when I'm scalping, but when I'm swinging, when I want to look at the long-term view of the market. For example, this was the predominant way for people to trade with no technical analysis at the time when there was only fundamental analysis in the market at the beginning of the 20th century. This was the only way for traders to interpret the price action by drawing what they saw on the ticker tape on the chart, and with the axis and with the X and a Y, they would be able to understand if the price was cheap or expensive. This was the predominant way of trading till the 1950s, early 1960s. Because some traders were complaining with the fact that they did not have enough information available from the past to operate some technicality. They invented a system called bar chart, which gives you, at any point of time, 4 different kinds of information. When the market opens, when the market closes, where is the highest point ever reached by the market during that time frame, and where is the lowest point as well ever reached during that time frame. You could find those bar charts on any time frames. So I will show you how this looks like. Sorry. For example, here on the chart mode, you will find bars. Not too sure if you can see them, so I'll put them in black. Okay, I'm going to explain something about colors in a minute. All right. Here you go. So when you see a bar chart, first thing that comes to your mind is that you see most of the time you see this long bar more than you can see these little hyphens on the sides. Look again. If I was to ask you, what is the most predominant view of this bar chart? Is it the high-low view, or is it these little hyphens on the sides? The hyphen is actually the interpretation of the open of the price when the hyphen is on the left, and the close of the price at the end of the lifetime of the candle, at the end of the time frame, which is the hyphen on the right. Every time you will see open price, let's say for example you have a hyphen on the left and a hyphen on the right, this will be for open, close, high, and low. If, for example, you were to see something like this, this will be the open, this will be the high, this will be the low, and this will be the close. Now let me show you how this works. If you have a start of a bar, it will look like this. Why? Because you will find on the same level, open, high, low, and close. Now let's say that the bar goes up. You will see something like this. Now we have the open here. This is also the lowest price at that time. You'll find the highest price at the time and the close. Say the candle goes more up. You will see something like this. The open doesn't move. Now we've reached, so if this should be the same distance. This will be the high and the close again. This will still be the open and low. Let's say the candle goes down now. Open. That high here doesn't change. And now the close is here. Open and low will still be at the same level. Now suppose the candle goes a lot down. The bar, sorry, goes a lot down. You'll see something like this. This is still the open. This is still the high. But this time, you'll face a low lower than the previous low and a close at the same level as the low at the moment. And to finish, if the candle goes up, the bar goes up, sorry, you will see something like this. This will be the lowest, open, close, and this is high. So in other words, you've started with a candle that went up, a bar that went up, went more up, started going down, actually went further below the open, and decided to close slightly above the lowest of the day. That makes it a downward bar. But the bar itself, in most platforms, will be displayed in black. This is the most predominant way of looking at the bar chart because it is mostly giving you the acceleration rather than the direction. Let me explain. You have, when you watch a bar chart, a high-low that is visible when the open close is actually not that visible. When I'm asking you what is the most visible points you see on the bar, is it the high-low or the open close? Most of you will think it is the high-low. Now, the problem of that is that the most important of those 4 points, open, high, low, close, is actually not the high and low. It is the open and close, because this is where market really wanted to start and really wanted to end the time, the time frame of 1 hour, of 4 hours. So it is what I call the IQ of the game, intelligent quotient. Open and close will determine where really the market wants to be at. And the high-low is what I consider as the EQ of the game, the emotional quotient. When the price explodes to somewhere where it is not supposed to be at, and to go down to a level where it doesn't want to stay at. And the problem is we don't see much of the open and close, we see mostly the high-low here. And this is why there is a third type of, a third way of reading the chart, which is inclusive of candlestick, which was created in the early 1970s. And today, we are operating on the basis of what has been created in the 1970s. So you see, we have not been very, very modern since that time. This is important. The reason why we have not changed our way of reading the chart is not something that is due to the fact that we are lazy and we cannot come up with something new. It is because most amateurs are okay operating on the basis of these information. And most importantly, the sharks and the whales want the small fish to operate only on the basis of those information and don't want to give them any adding value to their technical analysis. That's why, since the 1970s, the market has not changed the way it thinks. Because you are still, guys, thinking through candlesticks. So what you will see, what you will notice, when I'm plotting the candlestick chart, let me just change it for the other color. What you see here in most platforms looks like this. Sorry for the blue. Just going to modify this just a second. All right. So you'll find blues and red candles waving the price action. And this is how the big players want you to look at the market. Now, I'll be very, very straightforward with you. This is totally wrong. The reason is simple. You are looking at the market with a bias. The color is a bias. every time the price goes up, well, you're not stupid, and you can definitely see the price is going up. You don't need a color to tell you the price is going up. But the big players are giving you, and by big players, I mean also the brokers, they are giving you those platforms set up with this color code in order for you to continue thinking with the colors more than you would think with the price. In other words, every time the price goes up, moving the market with a sequence of blue candles, like here, the natural will be for you to think that now the price is expensive. Because after a series of blue candles in a row, the natural would be to think, to consider that it's time now for the reds to start. And this is how this is the kind of test I've made with some of my students in the last 2 years. I've been asking them when I was presenting them a price action, what do you guys would think if I was to show you something like this? A sequence of blue candles. What will be your interpretation of the next move? Actually here. You know, most of the time they would be telling me it's a good time to sell, especially if it's only blue candles, blue. If I was to switch to the bar chart game, and they would visualize the market more from a high-low point of view and not from an open-close point of view, the first impression they would have is, my God, Gary, there's an acceleration. They would see a huge candle, a huge size from a high-low point of view, and immediately in the subconscious mind, they will be thinking, I'm in the low part of this whole range, and there is a sudden acceleration up. Now, this is not the case at the moment. I can show you another one, which is under the same principle. Here you go, for example. You'll see something like this here. On the right-hand side, I will surround it. You'll face this kind of momentum. And immediately, the first impression would be, oh, I will definitely follow. But having switched, if I switch this to the candlestick, after a series of red, the first impression you would have is, it's time for me now to buy. Because this is going up, and now the price is cheap. Just by the lecture of the color, you would come up with that statement. And you see clearly what happened after. The price basically broke down and taking you with it. Now, what I'm trying to say to you is, the brokers have made this happen. They want that bias to be in your hands. Because once you think like that, they can take advantage of you. Now, if you remove their advantage by simply deleting the color, now you're going to see a complete different way of interpreting the market. You will be actually seeing the combination with the best of both bar charts and candlestick charts. Why? Because you can definitely see when you see the candlesticks, which are actually operate under the same principle. Sorry guys, the candlestick is exactly the same as a bar chart. It simply has this open close part that is filled up with a color, whether white or green or blue sometimes for an upward candle, and black or red, or sometimes white when this one is blue. This one can be white as well for a downward candle. So when you remove the color, what do you see? Well, you see the width, the wicks, those little parts that are at the top of the candlestick. These upward parts here, we call them the wicks or the shadows or also the tails. Call them the way you want. And the filled part is called the body. If you look at a sequence like this, you can definitely put your focus on this because this tells a lot about the market story. Same thing here. This can help you understand in which direction the market will go. But if you have a blue and a red on top of the on the body, you won't see any more those wicks. And the wicks is what you would see in priority when you are using bar charts. But when it comes to color of candlestick with colors, you won't see any more of those wicks. So I'm trying simply to give you the best of the bar chart, by means of which you will find when acceleration starts. And you will have the best of the candlestick chart, which is to highlight for you the open and close. Because you need those when you are plotting your support resistance line, when you need to assess what to do with the Fibonacci retracement levels and all. So this is very important. And I do all my trading on the basis of a black candles on white background, or you can use white or light gray candles on black background as well. But please, no fancy colors, no colors at all, if I could say, not only when you operate your trading on the charting system, or also on the ladder, if you want to trade on futures, the ladder. All right. Any questions at that time, at the moment? Let me just go through the chat once. Okay, very good question. Sorry, I didn't see that. What is scalping and swinging? Scalping the market, I'll show you. You see, like Indians, in North American Indians were known to scalp the forehead of their opponents. Scalping is basically the action of taking a trade quickly and getting out quickly. Let me show you what I mean by that. If you wanted to buy somewhere here, and you wanted to close that position here, to re-enter a buy here, to close it here, again, to buy it here, to close it there, and you would repeat this price action again here to buy, sell, buy, sell, buy, sell, buy, sell. You would be taking most of the nerves of the market. This is what we call scalping. It's this idea that you will take action in the market, not for too long, to take the most conservative, if not also called the most obvious price action of the market, which means that in between here, this starting point and this ending point, there is no chance that you would be facing any kind of resistance. Now, in a swing, you will be operating for a longer time frame game. Meaning, if you were to buy at this point of time, you would be selling at this point of time. The swingers are the ones who are not too fussy about the noise happening in the market on the way up throughout the acceleration of the price. They are basically entering at the best of the market time, at the best time of the market, and they are exiting at the best time of the market. Now, just to understand something, scalping and swinging, if in terms of price action, means the same thing. I'm explaining to you. The market is known to be fractal. I was about to explain that actually. Look, you are trading on D1 and you are looking at buying here to exit here. If I was to zoom out of the market to look at a time frame like week 1, this price action between here and here is now becoming smaller, looks smaller in distance. If I was to operate on month 1, this price action becomes a, give me a second. I'm coming to that. Look, guys, the price action now looks like as if you were scalping, because from a month 1 point of view, entering a sell here to exit here, entering a sell here to exit here, or buying here to exit here is similar than a scalping technique, because you are not going to take action to let it go till the end. You're basically shortcutting your profits. to take the most out of a sequence. You knowing that between the start and the end of the sequence, nothing can contradict with your plan. Now this can be assimilated as a scout on month 1, but when you move to a time frame lower, where there are noise happening in the market, and you are looking at the same sequence, it is a swing sequence for the D1 time frame play, for the D1 time frame game. Now a scalp for a D1 player, which is looking at the market from this price to this price, could be assimilated as a swing, maybe on H1. If I look at, or as H4, if I look at H1, because now I'm zooming in a lot. Let me just go. Sorry guys, takes a little bit of time. Give me a second. Something is happening. Yeah, internet has slowed down.
You can take up the second question.
All right. Okay. Let me see if it comes back. Otherwise, I will move on. I will come back to showing to you physically what difference it makes between a scalp and a swing. But I'm hoping that you're getting you got an explanation for it. I mean, now I can't see anything. Sorry, guys, I need your help. Can't see anything. I can't see anything. I can't see the Cisco WebEx. Oh, okay. Okay, I need to see the questions. Oh. Chat. Okay. Okay, sorry guys, I'm back with you. What can you explain the wicks again? Sorry, your video broke for a few seconds that time. No problem. Quickly.
You have to stop sharing.
Yeah. Okay, I'm back. So simply, when you see a wick, it is the part that is above the body and below the body. So this is a wick. Also called a tail, also called a shadow. So this is an upward wick, and this is a downward wick, above and below the candle. Sometimes you can find candles, candles without an upward wick, but just a downward wick, and sometimes you'll find candles with an upward wick, but no downward wick. And most likely you will find wicks above and below, because there will always be a reason for the price from the open. For example, let's say the open is here at this level. You will find a reason for the price to go down first, then to go up, and then to finish its price action by closing here at this level. There you go, for example. So it will have done something like this. If I was just to summarize this candle here, it will look like this. All right? The price action from the start of the hour to the end of the hour. I hope I've made myself clear for you guys. Now, let me go back. You're welcome, Husna. Okay. Let me see if I can see something. Okay, I'm not going to go that far because it takes time for the price to go back. So let me just go through this one more time with you. So if I was to sell somewhere here, in order to close my position somewhere here, this would be considered as a swing trade on H1. But if I was to do that trade on H4, or eventually on D1, there you go. I've kind of lost. Here you go. So from here to here is the same sequence that you have seen on H1, but from your look of D1 time frame, this will look like a scalping trade, meaning that this will be a shorter range price action on D1 time frame. But I know the question you might have is, then should we scalp? Should we swing? What is the best? Actually, you will always scalp. When you think about it, you don't know what's going to be the long-term game like. So if you are operating on H1, it is to scalp on H1. If you're operating on D1, it is to scalp on D1. That being said, if you scalp on D1, you can scalp on D1 playing an H4 game, playing an H1 game. You can act as a small time frame player, but by scalping the D1 game, you will be taking your trades, you will place your trades and the target profit and the stop loss based on D1. But this scalping on D1 will be apparent as a swing of H1. The only problem of swinging the market is that there's so much uncertainty. There are so many hurdles from the starting point to the end point, and anywhere in between that start to end point, you can face hurdles. You can face stops, blockage, support, resistance, anything that can come along with the energy of H1 that can contradict with your H1 time frame game. That is why you need to operate the market from the right time frame, and by the right time frame, the energy will be giving you opportunity to make money from a start point to an end point, in between which there will be no energy stronger than yours. Meaning, if you are on D1 time frame, when you buy somewhere here, to exit somewhere here on D1, you can't find yourself against a D1 game that is contradicting with yours, because you're a D1 player and this one is a D1 player, and the chances are that you will break that point here is 50-50. Now, if you find yourself somewhere on the way up against, forget about the D1. If you find yourself against a weak one player and you were supposed to act in the market on D1, now there's a big problem, because definitely the weak one player will be stronger than your game. The weak one player, sorry. So there is very, very little chance you will find the price action going beyond that point. That is why when we operate on D1, we make sure that the energy, when we start a trade, towards the end of the trade, is not conflicting with anything that is coming from the higher time frames. Which means that anything that can be of H1 nature, or H4 nature, or M15 nature, anything that you will find as a pressure, negative pressure on your trades, trying to push the market down, will have no impact in your trade, and the market will carry on. Okay? So this is important. That's why we generally scalp the market. I operate my scalping on D1 when I see there's a reason for me to go from point A to point B of D1. Now, having said that, I'm not saying that I will stay on D1. I can switch to H4 sometimes to take action in that D1 game. If I see my point A here and my point B here, I will be able to operate from a lower time frame in order to take more opportunities on the way up, so that from this point A to point B, I'll be able to play the market from here to here, then from here to here, then from here to here, from here to here. And eventually, I also have methods to take the retracement of this price action. So at the end of the day, you can make money on both sides. You can make money by following the trend, and sometimes by going against, but knowing when to go against, because you are operating on a different time frame here, here, and here, to make money as a scalping on the lower time frame. If you were to look at this action on D1, you won't see it. It will look like this. It will keep going up, 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 up. Most likely it will be clean on the way up. But if you were to find opportunity to sell here, to sell here, to sell here, you obviously need to look at the market from a lower time frame to show you some noise. And when you enter, obviously you need to know what you're doing, because you are playing against a bigger player here. Okay? So I'm going back to, where is it? Okay. What is the average healthy monthly ROI if my deposit is less than $5K? Look, if you are talking about operating on the Forex market with $5,000 and using a certain leverage, obviously, otherwise you won't be able to make enough or to use enough margin, enough deposits, borrowed deposits for you to trade. That means that you will have to have a certain leverage with you. If, for example, you have $5,000 and the broker is giving you 100 times that $5,000 so that you can buy and sell a certain quantity of products in the market. Well, I believe the ROI on average, not saying that I'm promoting anything here, but I've seen people generating between 5 to 10% monthly, regularly, being steady and consistent. But again, steady and consistency depends on your trading style. If you are scalping the market, you can be entering the market for less money, but you will be exiting the market more regularly, meaning altogether you will be able to stay out of the market during bad times, during news times. You won't be in the market during overnight times, and so you will avoid putting yourself in the middle of a game that is not yours. While swinging the market is an option, but not an option with your money. You can't stay too long in a trade. You can't play the market for on the high time frames for too long. In this case, you will need more resources, more money. I would generally advise people, if they want to play on D1 on the week 1 time frames, where they will understand what's happening in the market, to have a minimum of $10,000, really. Because you will see with $10,000, sometimes playing on D1 or week 1, you will just put one contract, 1K or 2K maximum, because you need also to keep some energy, some bullets for another trade. So you can't put all your risk in one trade. $5,000 is possible, but obviously your ROI will be bigger with 5,000, but your risk as well. And generally, I'm not operating on the level of risk that is exceeding 0.2% risk per trade. So if you trade for 0.2% risk per trade with an average of 3 to 5 trades a day, in between D1 time frame to week 1 time frame to H4 time frame, I would say you can make between 5% to 10%. All right. Okay, let me go back. What time is it? Oh, okay. So I would like, before we finish this session, I would like to share with you a technique. I'm using a trading tool, not an indicator, a trading tool called support and resistance. Now, this may sound very simple or simplistic to some of you, but it's actually the most complicated tool to use. Because if you don't put the support and the resistance levels at the right time, at the right place, you're going to end up being stopped out rather than finding a good momentum for you to enter the market. I'll repeat that. If you have a support and resistance and you plot it in a random way, it is exactly as if you were looking at me playing tennis and you were looking at Nadal playing tennis. And if Gary tries to put the ball on the other side of the net, on the square where I'm supposed to serve, if I manage to score 8 times out of 10 with my head, it's a miracle. I don't have the level of training that Nadal has, and obviously I don't put effects on the ball, and there's no speed. Now Nadal can do the same thing by placing the ball exactly where he wants, 1 centimeter, at 1 centimeter difference from where he wants actually to put the ball. So he has a 1 centimeter margin of error. And he puts the ball there with effect and with speed and accuracy. So this is exactly what I'm about to show you here. Support and resistance is not just looking at the market and finding levels where the market bounce on from at the lowest or on the highest. It's more than that. It's trying to find center of gravity in the market. So let me show you what this means. It's a support and resistance are horizontal lines like this. Okay, I'm going to put them in probably in pink so that everyone can see them. And simply what I'm going to show you is how to operate with those support and resistance. Generally, I put my support and resistance on the high time frames. Why? Because the amateurs are the ones who are plotting their support and resistance on their charts on the same time frame as the time frame where they trade on, which is fundamentally wrong. If you can plot something that is visible on the same time frame where you trade, you don't have an edge. You need to find where the higher time frame players put their support and resistance, and you should act on those support and resistance as a low time frame player. Meaning, we will look at the market on D1 in order to trade on H4. We will look at the market on H4 in order to trade on H1. Having said that, I'm going to show you now. I just started on euro dollar. Next time we can trade on anything you want. Look, I'm going to move this line down, and every time you will see a center of gravity, meaning a certain number of times when the price bounces on that support and resistance. It's called a resistance if the price is below, and it's called a support if the price stands above the line. But it's the same line. And if I go down, see, amateurs will do this. They will plot it like this, at the edge, at the end of this sequence, which makes no sense, because at this point of time, there is no more energy left at this level. There is no buyer or seller willing to wait for the market to go all the way up there before they buy, or before they open or they close a position. You need to operate where buyers and sellers actually trade the most. The fight happens when there is a change in the market direction. You see here, the price goes up, and then, bam, hits a level where the price comes back from. Again, the price goes up, and here you imagine a level of energy, a fight between buyers and sellers, from which the sellers now takes control of the market and push the price down in the opposite direction. If you see something like this, once, twice, 3 times, and eventually going back, not for too long, but seeing if there was a center of gravity here, look, buy, sell,
I cannot see the screen.
sell, and obviously you need to find a level where the price hits most of those points. One here, one here, and the most bounce there is, the most fight there is, the most intensity these levels have for the next price action. Here, again here. So obviously, if I start moving the line up like I did earlier, here, I'm not touching this point. If I go to this level, you see I'm not touching this point either. Here, I need to bring it down. So at least most of those points here and here are touching. When you find this, this is your resistance. I'm going to set up another one. Now these are vitally important because with those support and resistance, next time I'll show you how we enter the price action and how to take advantage of the market price. Now look here, the price bounced at this level, but it went through. It's true that it went through. So I'm not going to put my support and resistance here if there's no price action at this level. But let's see if in the past there's been something happening at this level to help me find what is the best level to operate on. Look, it seems like the market could be a little higher. See, this level here acts as a center of gravity to the price. I call this a magnet. The price oscillates in between this line, which is the mean, and bam, bounce on it, bounce on it, bounce here, bounce here, bounce here. So as you can see, I did not choose as a support and resistance this low. This is where amateurs will put their buy, and obviously, if you were to put your buy here, you will be in a trade that goes up. If you were to wait for the buy to happen at this level, at the lowest point of this sequence, the market will break, and you don't have an edge. So you can plot on average, on the high time frame, like I'm saying, an average of 5 to 7 lines. If you plot more than 5 to 7 lines, you are overfitting levels. Here there's 1, 2. See, I'm not choosing this low at the moment. Maybe it's wrong, but look, 3, 4, and eventually after that it's too far back. I just want to stay at the most recent time. 1 at this level. Now, is there another one here? Maybe. Maybe I missed another opportunity for a sell. I know some of you may think, but Gary, you're plotting too many lines. Remember, we are on the high time frame. See here. Okay, so if I just bring it down a little bit at this level, you will see I can fit this point, fit this point, fit this point. That's why you saw that nice that candle now bouncing on the line and now going back up. And there is nothing that will stop the price from going from here to here. Even though you may think, yeah, but Gary, there is this. Nothing will block the market to go from here to here. Because this is the path. And whoever has been here has already exited here and here. This is called the demand zone. So what I'm trying to explain to you through this little webinar is how important it is for you to use those tools correctly. Having used this on D1, having found 5 to 7 lines that you see on the same time frame, when you are looking at the price action, I'm giving you a small secret. I'm always looking at the last 233 period. Never more. You can't look at more, actually. There's no point looking back what happened before. This is the most important timeline of your price action, 233 period. Now, you know what's happening? Early in the morning, the people trading the markets will look back like this to check what happened before. And then we'll bring the price back to the present. And it is proven that after 30 seconds time, they have forgotten what they have seen in the past. So there is no point for you to watch that path because nobody will remember it, and everyone will operate on the basis of what they see in the last 233 periods. Once you're done with D1, you will go back to H4 time frames, and you will just need to adjust your levels to make them perfect for the H4 time frame. Meaning by perfect that you will need to make sure that they touch and you don't miss the line, the highest of each swings by 0.5 millimeter. So if I go back, I know it's a little bit far. I think nothing has been drawn yet. Okay, let me just check. Okay, this is a little too far. If I go just on this one, you will see, look, if you zoom in to this part here, I'm just gonna surround it, and I'll put it in no background in blue. You will see that it doesn't touch that low. So I'm just gonna move that line exactly on that point, and that's it. That's how I make sure that I adjust my line. Look, here doesn't touch, here doesn't touch, and that's it. So I could be missing the best point by 0.5 millimeter. If I just move it 1, 2, that's it. I've just added the most recent market story. Remember, the most recent market story is always more relevant than the past story. And you would see that on the low time frame, these lines are actually not support and resistance. They are center of gravities. Look at this. The price action waves around this line. The price action waves around this line. And when you think about it, where the center of gravity is the most important weight level that you need to act on it, not where buyers, amateur buyers enter or exit. All right, so once you have adjusted all your D1 levels on H4, making sure that they touch the candles of H4. Here, for example, I need to adjust it a little bit up here. Here, that's it. Now you're good to go. Now you can start trading on the basis of the support and resistance. It doesn't take long for you to plot them, but before you start plotting your support and resistance, it is important for you to know on which time frame the game happens. So this will be on the basis of a next topic that I will be spending time on the next webinar. For now, for today, I think our time is over. I would like to thank you all for attending this webinar with me. It's been a privilege to have you for 2 hours, and I would like to take 5 minutes of your time to introduce to you what we are doing here. At Professional Traders Club, we aim to provide people who are amateurs.
Yeah, you didn't share your screen, so they were opening it with that.
Oh.
So can you spend 5 minutes in
Oh, sorry.
That's what I told you.
What, it was not visible? You didn't see? Oh, sorry guys, sorry. Are you all with me?
Can you give them 5 minutes and do support?
Yeah, absolutely.
Yeah.
Okay, I'll repeat it from the beginning. So sorry. Okay. Let's go back. For those of you who have not heard me, it's okay. I'll repeat it. I'll do it again. Very sorry, guys.
The focus didn't come because you were.
I know. Sorry, guys. So sorry. Truly sorry. Okay, no worries. Now, I hope first you were listening to me. It will give you. It has given you a little bit of idea of what I mean by support and resistance. I'm going to show you how I plot my support and resistance. First, I need to go on the high time frame. Okay. On the high time frame, I'm not looking for the highest point here of a particular sequence. By sequence, I mean here, the low of that sequence. I'll plot a line here on the bottom, or sorry, yeah, set as default. Okay, like here, or a high here at the top of this sequence. That is not how we plot support and resistance, guys. Most people who are doing this, they are doing it in a very amateurish way. And it's very important for you to know how to plot your support and resistance right. Otherwise, you don't have an edge. You don't get to see things that the amateurs cannot see. Amateurs will put their support and resistance, like I said, on the same time frame where they trade on. So I'm going to show you what is the edge here. It is to find, as you understand now what a resistance is, it is a level where the price bounces below that line, okay? And we call it a resistance. It's meant to be like a ceiling where you cannot break. And the support is the same line, but depending on the role it has, for example, here it is a resistance. And now this level of the price acts as a support because the price bounces on it. It acts as a ground. But we cannot use those lines. So I'm going to tell you first what you need to pay attention on. D1 is your high time frame. You need to look for the level that actually are the highest lines, okay, the height level that touch the most tops. 1, 2, 3, where there is a lot of price action happening. In other words, you need to look for the price when it comes to the end that is now fighting between the buyers and the sellers. If buyers and sellers fight like this, at some point the sellers win the game and push the market down. If this is happening, obviously, you know there has been a lot of volume that has been exchanged at this level. Again, this is repeated here. You forget about the wicks. We are making sure that wicks can travel, but body of the candle does not travel, does not break through the line when we plot it as a resistance. Same thing when we find supports. We make sure that we don't plot a support where the market story breaks through the support like this. So we need to act as a support where the market sits on it. Eventually the wick can go through, but not the body. No, so let's go back. So this one here, look at the top, you'll find it has touched once, the price action touched the level once, twice, 3 times, and if you go back here, you will see that it has touched 4 times, 5 times, 6 times, 7 times, even though this happened in the past, 8 times here. So, and 9 times on it at this particular level. So there's been a lot of price action happening around this level. Now, if I was to take action like this on the basis of the present, I was just telling you earlier, if I was just to support myself at the highest, ignoring this level. You see, if I ignore this level, I would also ignore this level here. And that's not right, because there's been also a lot of price action happening here. See, the body, now of course, yes, it's traveling, I know, but this has happened in the long-term past. We are talking about the short-term past here. Most important that the short-term past, the body doesn't go through. And you will find a support and resistance that is the highest in that market story, taking into account the most lines. And obviously, when you go back, you need to make sure that it fits the past picture. If you have these ingredients in place, you have a very good support resistance. Now, I'm going back, I'm going down, I'm going to stop as well on a level that would make sense to me. For example, this one. You see the price action bounced here and went up, bounced here and went up. We cannot touch everything. Let's go back. Here you go. It doesn't actually, there's no price action here, but there's one here. So if I was to adjust it to this level, what happens to the past? Look, it touches here. It could eventually touch also this one. Okay, good. It cannot touch everything. So obviously the past will be less relevant. Look, this one is perfectly adjusted. And if I go to the present now, I can make sure that my body doesn't break it, and that's it. This will be, if I go back to make sure it touches, yeah, that's it. It's more than enough. Generally, to plot support and resistance, guys, I'm looking at the last, not 233 period, but 466. 466 is roughly from here to here. Roughly, I'm looking at this. Now, if you don't find much information to help you to adjust those levels, exceptionally, you're allowed to scroll back to find one point to confirm this level is good. Now, you see the difference between where I plotted my support and resistance and an amateur plotting its support and resistance here. The difference between the two is, if I was to take action here, somehow, for example, I needed to buy somewhere here, you will see that the price action will be going up. But if I was to wait to the last door is breaking, there's no more energy left at this door for me to, for the price to be supported by buyers, because all the buyers have tried to buy before reaching the last door. This is one man. You have to understand, there's no energy in the buy at this level. And look what happens, the price breaks. So amateurs, they get stopped out. They will panic while I will be already exiting my trade with a profit, because here there's a door. So I will be entering here for an exit here. Now, I'm not saying I would have taken that trade. I'm just giving you an indication of what is happening right now in the market. Now, I'll continue with other lines. What about this one? See, if I adjust this level, 1, 2, 3. I'm trying to take most of the tops. I cannot take this one, otherwise the body will penetrate. The resistance, the price will penetrate with the body through the resistance. Now this one is okay. If I go back to confirm it's all right, look, this has stopped exactly at the low. So it's a perfect level. It's perfect enough to show you that right now there's a price action happening, and you see the price is actually going up from bouncing on this support line. You understand? And having said that, this was the best buy for your price action, and the best exit for that price action, I'll tell you now, is going to be somewhere here. I know some of you will probably tell me, but Gary, there is a door here. We might not be able to get through that because there will be some players here who are looking to exit this trade. Now, I'm telling you, this is a particular price action that is called a demand zone, and most of the sellers who have tried to to enter on the breakout of this line, they are trying to sell to push the market down. All those sellers have been stopped out here. They've been panicking. If they have not yet died, the sellers would have already closed the position here. If not here, here. So there is no seller trying to block the price anymore. And the buyers who are acting here, some of them would have already exited the position on the way down. If not, they will have exited the position here with a profit. If not, they would have exited the position here with some profit. So they have many, many occasions to exit. Whoever is left here is almost nobody. So the price will be going up till reaching that door. All right. So this is not for me to tell you, to give you a trade, and this is just to give you a tip of advice. Now, if you were to continue with your resistance, support and resistance, maybe there will be another level somewhere. Help me out with this. Somewhere here. And if I go back, you see, wow, the price touched exactly on this line. Now, you see what I did? I did not choose this point, because on this point, there's nobody. There was one, but it went through. There's nobody that stopped here. Oh, there's one here, actually. Very, very long-term path. So it could be a good level, but there's much more price action happening here at this level, where the bodies are 1, 2, 3, 4, and the most recent past, 5. So to me, this is a fourth support and resistance, and it acts as a center of gravity to this price action, if you can see. All right, so altogether, if you have finished to plot all your levels, you will find an average of 5 to 7 lines fitting one screen. And remember, one screen, when you check the last 233 period, one screen will be looking like that. If I check another fifth line somewhere, actually, maybe this one will be one. Let me have a look at this. No. Yeah, maybe this level. 1, 2, 3, 4, 5. And I will just push it up a little bit. Actually, a little more down, actually, sorry. Yes, 1, 2, 3, 4, 5, almost 6, 7. This will be my last one. So this, I will show you now 5 in the last 233 period. Now, when you're done with this, you go into the lower time frame. Just let me have a check on the chat room to make sure that you guys have no question. No, okay, perfect. So let me go back. Okay, now you go back on H4, which is the lower time frame where you will be trading on, and obviously now those lines look much more space from each other, which is why you should not feel bad having more lines. Yes, absolutely. Lines can be subjective, and everyone has its own saying to which line to take. But believe me, for doing a lot of research on those support and resistance, because they actually are helping me a lot to find where the amateur stop loss are. They are the center of gravity of the market. They are the levels where the support, where the H4 players enter the market. So they are basically the levels where the H1 players stop losses are. So I'm going to H4, and now you will see the reason why I'm going to H4 is to adjust my D1 levels. Look, if you focus on this zone here, you will see that the line, the wick doesn't touch the line. So you need just to adjust the level by 0.5 millimeter only, not to change completely the nature of that resistance line, but just one line to fit perfectly the market story. Now, sorry, but there is nothing in the past on H4, so I have to stand by that one line here. That's it. Now the next one, of course, you will see that there are some body going through the resistance, the support and resistance. But remember, these are bodies of H4, not body of D1. This is very important. So look at this. In this case, it looks perfect here. Perfect. It's okay. It looks perfect here. So there's nothing to adjust on this line. Now let's look at the next one. Here, for example, you see that point at this level. You'll find that the price doesn't touch this line, and you'll just need to adjust the line a little bit. So that's pretty much it. One here, you look back, you make sure that nothing gets affected in the past. You obviously can't get this point, and that's it. The last one, this low level needs to be adjusted a little bit up, and that's it. It touches here. It can't touch everywhere, guys. Again, it could possibly touch a little bit here, so that you fit this picture and this picture, and this one. See, that's it. Now you have almost included everyone in this one, and it's more conservative, right? So if you were to buy somewhere here on H4, it makes more sense not to miss the trade for one little unit or 2 little units of distance. Okay, So now you have what it takes to plot support and resistance. You start from the high time frame, you find 5 to 7 lines on average, and after that you go into the lower time frame, the immediate lower time frame, so from D1 to H4, from H4 to H1, and you adjust your levels. And now you trade on the lower time frame, meaning you trade on H4 in this particular case. And that's it. You have everything. You have everything you need now, guys. So next time, I will be having more time to dedicate to how to use those support and resistance in the grand scheme of things, because obviously you need now to know how on which time frame to operate. I would not invite you to plot those lines and to trade on the lower time frame of a random time frame. You need to know where the game is played, and it's obvious that in 2 hours I did not have time to give you this this information. So my point here is I would love to reinvite you for another webinar if you're interested in what we do. Just for you to understand in 5 minutes, we are operating as a training center, and as such, there's a lot of research and development that we do here. We develop our own tools, we trade our own models, own strategies, and obviously nobody out there have those strategies in place, which is where we get our edge. We build those tools and we provide them to our traders and our clients, trainees. So I'm here to show you 2 ways for you to gain access to my tools. Either you can operate here as a trader and you can rent a desk and you can be here with me and you can have access to the course. If you have a rental desk for 1 year, you can have access to the course for free, which is inclusive of all the different levels from Jumpstart to Pro Trader. Or you can choose to come and attend my course. You're more than welcome to come and meet me. We can have discussions around your levels of trading, the type of trading you want to do, the products you want to trade on, and obviously your trading style as well. Every trader is unique in a sense that we don't generalize our training to everyone. We custom made it for each and every one of you. Because you are different, you think different, you act different, the psychology part of a trader is very important in our training, which is why I'm inviting you to come back to the next webinar, to re-attend another session if you're interested in what we do. And thank you very much for spending 2 hours, almost and a half with me. If you have any question, yes, you can visit me, as I told you, Bakai. Just one thing, depends when you come. It's already 5:30. I will probably stay here for another half an hour. I can wait for you if you're coming in, let's say, half an hour time from now. Other than that, we can meet sometimes on Monday morning. I'm open. We are open from Monday 9 a.m. till the end of the day. I finish my classes around 9:30 p.m. So we can meet after 10 p.m. So I'm pretty flexible for you guys. All right. So if you're in GLT now, okay, you can come right now. I can wait for you in, let's say, half an hour to have a discussion with you. I'm more than happy to meet you. Okay, see you, bye. So thank you very much for attending this webinar. And you can find this video that is recorded on our website just after I shut down this webinar. We will send you a link for you to access this video. And thank you very much again.